So right now when we're looking at the investment markets, the first thing we do, as always, is we start with the economic backdrop. U.S. job growth remains strong. Economic growth remains solid. So from a U.S. investor's perspective, things look very good. However, we have seen some weakness on a global basis. While nothing major, we've seen a little slowdown in Europe. We've seen a more significant slowdown in China. These things could eventually affect the U.S. market. So with that, we've taken a slightly more cautious approach over the next couple of months to our investment process. We have been saying that we should be seeing interest rates moving higher and bond prices moving lower. There are a couple things driving that. One is a stronger U.S. economy. Two are the actions of the Federal Reserve. So back in 2008, the Federal Reserve began to go out into the market and buy bonds and create cash from nothing. They printed it. This put a great deal of cash or liquidity into the system. Right now, they're reversing that process. So the cost of credit, the cost of borrowed money is going up. A way to think about that is credit or liquidity is really the grease that allows the economic wheels to turn. That's the funding for new businesses, for startups, for existing businesses that want to expand. So as the Federal Reserve begins this process, they're essentially now selling bonds and taking liquidity, taking access to money or making that access to money more expensive for people that want to grow their businesses or expand in some way, shape, or form. More importantly, for investors here in the U.S., especially fixed income investors, I think the expectation is we should see interest rates continue to move higher over the next couple of years, bond prices continue to move lower. That means when you're managing through this process or through this time period, it's going to be very different than anything we've seen in the last 30 to 40 years. Switching to the stock market, we've become a little bit more cautious to the stock market. We still think it looks good. We still think the outcomes are going to be positive. We believe we probably have another 5 years plus to this expansion in the stock market. Having said that, we've seen some indicators that tell us to become a little bit more cautious. Think of it like a flashing yellow light. You can still go through, but it's best to slow down a little bit, look both ways before you cross the intersection. That's essentially where we are right now. So we're allowing cash to build up in our accounts, and we're coming into what is historically a seasonally weak period. August and September are the two weakest months of the year, and of course this is a mid-year election year, and emotions go up during election years. So we're likely to see a little bit more volatility in the equity markets as we get into the election. Once we get through this, we think we should see a strong year end and probably a strong 2019. So right now we're just being a little bit more cautious and looking for opportunities that we think will present themselves over the next couple of months.